Okay, let's get started. The presentation style is a mandatory participation, meaning please react, please say. It's not a voluntary, participation, but a mandatory. So when I ask something or when I say something, I need your reaction. Otherwise, I think you're gonna, I as a speaker, I'm gonna think you guys are asleep and you're not with me. So that, not really, and it really damages my ego. So I need you to help my ego stay afloat or at a high level so I can, continue and be focused. So please, ask questions. Those of you who have heard me speak before already know that. Crack a joke, that's fine. Make a comment, suggestion, anything, everything is fine. You can step aside and dance if you want, that's fine too. All right. What I wanted to do today is actually take, at least kind of focus for a few minutes on how I analyze properties. I think that there is a lot of knowledge out there how to analyze properties. And when I say analyze, I'm talking about financially analyzing properties. I'm not going to talk about the aspect of the area, the metro, the quality, aspect of the property, and I'm only referring in this presentation for rental properties. But I want to create a little bit of, an equal understanding. And I'm not going to talk about every aspect of, analyzing properties. I'm going to focus on the main ones that are relevant for us, and I'm going to show you what tools I'm using, what tools that are available out there for you to use. So let's get started with that. And I'm also going to show you what is commonly out there when I go to events and I see people present and why I think it's not good, whatever is normally out there. Okay, so disclaimer again, vet, verify, remember, practice safe investing, make sure all of that is done on your end. Definitely don't come back and say you told us to do so. Okay, everybody's okay with that? Yes. Okay? Yes. Thank you, that is much better. Perfect. Oh, of course, one more thing. I record the webinars and I put it online. You can go on my website, connectrei.com. Rina, can you turn off the lights? Thank you. So you can go to Connect REI and look at those videos. They're short, short videos that I've put together, like few minutes, 2, 3, 4 minutes, and they're full, lecture videos there. Tons. Every webinar goes up there. This is a recent webinar we did, so it's available online already. Okay. Let's focus. Again, what I'm saying is, can you guys even see me? Yes. Okay. I'm not, I'm 10 and, okay. It's a little bit dark. Have a seat. Thank you. All right. So again, I'm going to focus on the main factors, the main parameters of analyzing. I'm not going to go into every aspect of analyzing, but I want to make sure we are all on the same page. All right. Who does not know what an ROI/return on investment is? Perfect. Don't be afraid. Don't be ashamed. It's all completely okay to say if you don't know. Return on investment is one of those key metrics we use to measure an investment. What is the return we're going to get on that investment? This term is being used by different people in different ways. Okay? Here is my way. I don't know if the best way, the wrong way, the right way. I just know it took me a few years to come to the conclusion this is how I should be looking at investment properties and measure the return on investment. First of all, return on investment for me is a combination of 3 factors. Remember, I'm talking about rental properties, okay? Rental properties, I'm not talking about flips, I'm not talking about commercial, I'm talking about rental properties. So, return on investment includes what's commonly known as cash-on-cash return. Cash-on-cash return, what is the cash flow at the end of the year? Divided by what I have invested in this, investment at the beginning, okay? And we're going to show you what that is as well. That is cash-on-cash return. Return on equity, okay, is what I am building by, the amount of equity I'm building up by paying off the mortgage. Okay? So that is the return on equity. And appreciation, how much is the value of my asset appreciates year after year. Okay? So whatever that appreciation is, all of those factors for me are part of the return on investment. There are other metrics we can use, but those are the most commonly used, very easy to calculate, rather easy to calculate and to understand. Everybody's with me?
Yes.
Thank you. Questions so far? Can anyone tell me what is written in cell A6? Okay, I don't know either, I'm just kind of guessing. Okay, this is my Excel. Took me many years to put together. What is different in this, from this Excel, besides the fact that it looks overwhelming? It does, right? It does. So my Excel, don't worry about the fact that we can't see all the details. I'm gonna, take snapshot out of it in a second. The one thing I want to show you at this perspective is when I analyze a rental property, okay, I spread the numbers over 30 years. So what you should be looking from here is there's 30 years worth of data in this Excel. I don't dive into the fine details of this, of all the 30 years, but I want to spread it over 30 years. There are assumptions we're going to do, and those assumptions will behave in a different way over the long run, okay? And it doesn't matter, my Excel by default is 30 years. It doesn't matter, the fact that I may hold the property only for 5 or 10 years, it's irrelevant, and I'm going to show you why in a second. But I spread it over 30 years because that's how I'm going to be, analyzing or pulling data out of, the Excel for the property. So let's move forward. Again, 30 years, we don't care about that. We care about those things. A couple of things that we have here. So, because we don't have a lot of time, I'm not going to go and dive into every little detail of that Excel. I'm just going to briefly describe a couple of things here. So the specs of the property are here, bedrooms, bathroom, etc. What's the purchase price? How much are we going to put in improvement? Closing cost? What is the market value? Down payment? Financing info, etc. And this is one of the key numbers many investors don't know how to find. It's my cash outlay. How much is this investment actually going to cost me? Down payment, improvement, closing costs, whatever fees I have, that's the number, that we're all going to use to analyze with. So that's not, when I analyze a property, I don't analyze the down payment, which is, let's say, 20% of the purchase value. I analyze actually how much it cost me to purchase that property. Remember that with closing costs, this property, for example, the down payment is $32,500, but the total cash out of my pocket to buy it is a little bit over $37,000, just to give you a number, okay? We're not going to talk about that just now. Give me one more second. We're heading there. Then we have all the assumptions. For example, the annual revenue increase, meaning how much I expect or anticipate my rent to increase on average from one year to the other. Rents do not increase in a straight line of 1.5% annually. They normally increase in this way. They normally flat, 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 flat. Okay, let's do it here. Flat, then jump. Flat, then jump. Those jumps are typically when a tenant moves in and a new tenant moves out. Okay? But again, I don't care about this behavior, because I'm putting it over 30 years. Same thing for the expenses. What is I expect the expenses to increase year after year on average. What is the rent, the vacancy, all the expenses, property tax, insurance, maintenance and repairs, utilities, advertising if it's irrelevant, property management cost, leasing fee. Anyone does not know what the property manager is? There someone in this room, and please raise your hand if you don't. What is the difference between management fees and leasing fees? Okay, who can tell me what are the differences? You don't. Thank you very much. I owe you a prize. I didn't bring one today. Okay. Management companies, property management companies charges two types of fees typically. Well, several fees, but mainly two. One, monthly management fee, maybe 8, 9, 10%. It's typically what I see. So that is the monthly fee they're charging out of the rent. Leasing fee is to get the property rented. It's a rentability fee, if you want to call it, or to get the first renter in. Many times this fee covers marketing, advertising, and bonus to another agent that's bringing the potential tenant to the property, and then he gets compensated for the fact that he brought that person. At the commission, he gets that commission. That is the leasing fee. Leasing fee is typically paid out of the first month rent. Many times is anywhere from, I'd say, half a month's worth of rent all the way to a full month. So that means if your rent is $1,000, it will be anywhere from $500 to $1,000. Every company does it a little bit differently. And those are the typical fees you will charge. You will pay. The leasing fee is typically only paid when a tenant moves out and a new tenant comes in. So you can call it the tenant acquisition fee, so to speak. Okay. And HOA, homeowners association, all combined, and we have how much expenses we have for this property. Then this is actually continuing. So if I look back, we are, sorry, wrong button. Now you know the end result. Okay. Yes. Success. Okay, so we are looking here in my Excel, and now we're moving down here. So you know where I am, and you are able to follow me a little bit. Now I can tell what is my net income before mortgage. Okay, so that means rent minus vacancy and expenses. Then what is my mortgage payment? And then what is my actual cash flow? Average actual cash flow. Why is it average actual cash flow? Because homeowners association and property taxes are not going to be paid on a monthly basis. They're probably going to be paid 3 or 4 times a year. So it's not going to behave like this in my activity or my property activity sheet, but on average, month over month, that's how it will look like, should look like. Now, when I work with my teams and when I present properties to my investors, I put those numbers very realistically. I don't go to the worst case scenario. I don't go to the best case scenario. I go to the beautiful scenario called realistic case scenario, okay? So if you put best case scenario, that means obviously who knows how the property will actually behave. If you put worst case scenario, from my experience, we will kill the deal. I've killed many deals like this for many years before actually realizing you have to take a chance. So so what I use is realistic numbers. I verify the information that is provided to me by my teams, but I plug those realistic numbers in. Then, also one other thing that I have here is the annual appreciation that I expect this property to do. In this case, it's the 2%. Excel being Excel, everything is very flexible to change, so we can change that number as much as we want. More or less, that's fine. Now, I'm not going to go into every detail, but I just want to show you this Excel is showing you what is the annual cash flow, what is the cash on cash return. The total ROI is actually the cash on cash plus the equity that we are building. But this is the first year kind of analysis, which is a very, I want to say a little bit off, okay? Here's what I like to do. 5 years, 10 years, 15 and 20 years. That's why I spread it over a 30-year type of an Excel, and then I take the first 5 years, and then I get the average per year based on the information for the first 5 years. That is the appreciation, the amount of equity that I'm building during those 5 years, and the cash-on-cash return, and that is the realistic number to present for that deal. The annual, for the first, annual average ROI, combining those three parameters, is 26.3%. This is actually a true property. It's not for the sake of this presentation. Yes?
So I got a question on how you calculate the positive cash flow. Is there a, say, discount rate? Because usually once a tenant moves out, it's going to take you a little bit of time before you find a new tenant. What is a safe rate?
So you mean a vacancy rate?
Yeah.
So
duration of vacancy.
Yes. So I ask my teams what they know about the vacancy in their area, because if you look at if you can find a figure for the marketplace, it's for the greater marketplace. It's not necessarily for this zip code or for this neighborhood. So I follow, my teams, whatever they say. I kind of maybe add to that a little bit. So if they tell me it's 8% annually, I maybe take it to 9 or 10, not a lot, just to have a little bit of a buffer. But based on my experience, tenants do not move in and out. At least this has been, over 10 years of investing, my own portfolio, in multiple properties, multiple states. Tenants do not move in and out every year. Typically, I would say 2.5 years, and that is a similar number that I'm getting from my investors and my other, people in the network. So I take 2 years. My assumption, again, realistically, I measure the vacancy. If it's 8%, let's say the figure is, I calculate annually 4%, because the tenant doesn't move out every year on average. Okay? Does this answer your question?
Yeah.
Yes.
Is that annual ROI, the 26%, is that on the total cash that we invested, the money that went out?
Yes. So everything is based on the amount of what you actually invested into the property. Okay?
Whatever the 30,000 we saw in the beginning slide.
Yes, the 37,300-ish. Yes, absolutely. And again, you see the same concept I'm going and I'm using for 10 years, 15, and 20 years. Okay? That's how I use my Excel to really get, the figure. Now, one little thing that I use in order to see the purchase price, how is it relevant to the marketplace, regardless of the fact that I may or may not use an appraisal, or, first of all, please don't Zillow properties, okay? Zillow is just kind of like browsing a little bit, and just Zillow is so not accurate. No disrespect to Zillow. I love the tool. It's an amazing tool. I use it. But when I get investors that are, I send them a property and they're coming back and say, Zillow says it's, $20,000 less, it's just irrelevant, this answer. Zillow doesn't know the condition of the property, if it's terrible or amazing. Zillow doesn't, in Atlanta, for example, we buy properties at the, at the auction for so cheap, and that's why it gets recorded, as a cheap property purchase in the Atlanta metro, and then we're going to put $20,000 into it. But the Zillow will tell us we'll purchase it for $40,000, but we actually paid 60 or maybe 65 for it, in order to bring it to up-to-date shape. So that is not, Zillow does not take that into consideration, and the comps are going to be 40, 43, maybe 37, who knows, maybe even 32. So it's all over the place. So please be aware of not, using Zillow beyond, get a feel for that. It's far from being accurate. The one thing, okay, over here, the one measurement that I can trust and know how much I'm paying for this property versus how much it should cost is what's called either the replacement cost or how much is it going to cost to build this house. Okay? So in this case, this house, the price per square feet is $71 and a half dollars per square feet, and the replacement cost, it's $100. By the way, that does not even include the land. So that means this house should have cost something around $180,000. I think we're buying it for $150 or so. We can look at, I think even $130. We can look at the numbers in a second. So that just tells you where are you relatively to the true cost of how much this house, is worth. In my mind, once markets are, by the way, many markets in the United States, I don't know if you know that, are already improving, are already creeping up or actually increasing in prices. So if you're not aware of that, the media may report we're still in a recession. different markets around the country are behaving in a different way. So we are having hard times buying in many of those markets properties for the reason there are multiple offers on every property. But when things really pick up, I think those properties will have to jump to that price, to how much it's really going to cost to build it. And when I say really going to cost, it means nails and laborers and workers that come on site and build and wood and whatever it takes to build a house. Those are the true cost of that. So that gives you an estimate, and that is part of my Excel built in, of course. Let's see. Okay. Here's something I don't really like. I think it's a little bit superficial. When you go out there to events, that's how you get typically presented with properties. There's a photo and maybe a little bit description and maybe, I don't know, and it just says all of those. First of all, where is the vacancy here? If anyone can find it, let me know. I just can't find it. How about leasing fee? Okay, so this cash flow, 336, it's okay. But is it really 336 realistically cash flow? In my mind, it's probably not going to be that. It's probably going to be okay. It's probably going to be $200 or so. But this is how a lot of people present properties, and in my mind, is just way too superficial to analyze and get an assumption based on that. Okay, so it's maybe kind of more to attract you, but don't look at those numbers because they're not going to tell you the whole stories. Few of the tools that I'm using. So you already know about my Excel. And you can have that. If you want, I don't have, I'm sharing it with everyone. You just send me an email and you can download and you start using it. No problem. The property tracker, which I'll show in a second, it's a tool that is very similar to my Excel and then some. That's the reason I chose to work with that tool and integrate it or embed it into my website, because I found it to be almost similar to my Excel and more than my Excel. And that's why, and I'm going to show you that in a second, and that's why I chose to work with the property tracker, which is hosted on my website.
Dani,
Yes,
what is this website? Connect Area.
that's my website.
It's your website?
How can you even ask me that question? Do we know each other from yesterday?
Simplydoit.com.
No, simplydoit.net, you see again. And this is my listing website. My properties are going on Connect REI. I thought it's, you know what? Thank you. This is I have two websites. This is my listings website, and it has, a little bit more information. So, and my other website is simplydoit.net. Remember that, please, next time you go online. We were on Property Tracker, and then two other websites that I use to pull information is finestexpert.com, that gives good comps for sales and good comps for rents, and gives you a little bit of an analysis tool, not as thorough as my Excel or Property Tracker, but still nice. And then real estate analysis, this one says real estate analysis free.com. I know it's a little bit hard to read. Realestateanalysisfree.com is one of those free websites, obviously, that you can, gives you some analysis, but it also enables you, if you save, let's say you upload information about 4 properties and you want to kind of measure them side by side, it will help you put them side by side and kind of look at them, so it's kind of a neat tool to use. Let's look at Property Tracker. So connectrei.com, my website, this is what you will find once you do a search for properties. This is based on Plano, so everything in Plano came up, and it gives you a little bit of information, and if we click, I think on one of the properties, so we have all the information here. This is a 1-year projection, so it tells you, over here it tells you the cap rate, cash on cash, total ROI with tax saving. I told you my Excel and then some, so that's where it means. Gross equity, income, It gives you here, I'm just showing you those neat parts and gross equity income with tax savings. There are more, obviously, I know it's tiny, but I just wanted to point out those main metrics. Also, Property Tracker gives you a 10-year. So here is where my Excel is better. This is only 10 years, but it's fine to get a good perspective. And what my Excel doesn't have, and Property Tracker, at least my Excel doesn't have just yet, and Property Tracker has, is sales analysis to become, to be added to my Excel in the near future, I hope. And it gives you comps from Zillow, okay? So don't look at the comps, page, of course, and some analysis, graphs over here. Property Tracker on my website. Okay, questions so far? Is there anyone in this, Rina, did we bring the exams, the surprise exam for everyone here? Because they're gonna need to do a trial of analysis, Everybody's ready for a test?
Yes.
Okay, good. Yes, I saw a hand coming up.
How do you treat depreciation expense?
How do I?
Treat depreciation expense.
Depreciation?
Yeah.
My Excel doesn't tackle that because it's a little bit more complicated, and I need to. It's one of those things I want to add to my Excel.
IRS publications.
IRS complications?
Yeah.
Well, depreciation is very easy to. Basically, it's easy to. You take the property value divided the land, sorry, the improvement, the building, the house, not the land, divided in residential for 27.5 years, and then it's as much as all the experts that are speaking here about that, it's not you don't elect to take it or not, you must take it. So let's say, in this case, you're going to have $3,000 a year worth of depreciation, and you just deduct it on your Schedule E. So it's not reflected here. In some instances, that may improve your tax savings or your personal tax. In some instances, it may not. So it's really on a case by case. Okay? November CPA, bring that question with you. Okay? Yes. Any other questions? Yes.
How did she figure out that the cost to build a per foot was like 100? Why did she choose that?
I spoke to my team in Dallas. That's a property in Dallas. I asked them what would be a normal price to build in that area, and they said 100. So it varies.
So are you saying that if a house is valued at 70 square feet, so $70 per square feet, then the house is undervalued? The most houses in the Bay Area are way more than $100.
So this is a Dallas property. Remember that here, I would say $250, $300 is a very cheap, dollar per square feet, building cost. So that figure would be $300 probably in my Excel if it was local. Obviously, it would either be a mobile home over here for 150, or doesn't exist, or just a different number. Okay? Or show me where we can find this nice $150,000 home in the Bay Area. I mean, here, not in other parts of the Bay Area. Okay? Yes. Any other questions? Anyone feel a little bit lost? Okay. So if you do feel a little bit lost, not sure how to go, first of all, don't panic. Okay? And what I want to offer you is come and see me. Some of you have already. Some of you have not. Those of you who have not, please raise your hand. Go right now. Just kidding. But if you are feeling a little bit lost, if you're not sure how to go about investing, if that Excel is way overwhelming for you, you're not sure where you should invest, Bay Area, out of the Bay Area, what you should do, or what are your goals? You can't even define your own goals, how much money, where to get some. All of those issues, I've been working with investors for the past 8 years, meeting with one-on-ones. I've met with few of you already. And then I have, like I said, I have those teams of agents, property managers, rehabbers, etc. in Dallas, Atlanta, and Orlando that are helping my investors to put their money to work in areas that are not necessarily expensive, such as where we live. Okay? So if you do want to meet with me, we can do it by phone, Skype, or in my office in Cupertino. You can register, you can let Rena know. Rena, can you raise your hand? All the way in the back. Thank you. A little bit in the dark. And with that said, do we have any more questions?
I wanted to go back to that other part with the value.
This one?
No, one more back.
This one?
One more.
This one.
Oh, man. One more.
Thomas, you have to help me out. Okay, you tell me when to
We
stop.
were talking about
Here?
the purchase price, right? And the value price.
Mm-hmm.
And I think the people
I'll find it.
realize here is the value of the land is actually worth quite a bit.
Right.
So in that instance where you're looking at the value, you're getting the land for free is what can happen.
Yep, absolutely.
Whereas here, the land value is so high.
Okay. All right. Do we have any more questions? Very good. So what we're going to do next is we're going to take a little bit of a short networking break. For those of you who have been here, you know the drill. For the newcomers, the drill is very simple. You just please stand up. This time you turn to your right, introduce yourself, and we're going to adjourn for our main presentation in about 5.5 minutes.